Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So it's been a while, but let's talk about some flurry of data and news we're getting. Especially this month is going to be an interesting month because not only we got some jobs data that have already came out, but we also have the government jobs data coming out as well, the non-farm payrolls report, which we haven't seen in some time due to the shutdown. So that's going to be super interesting. And along with also the US Fed rate cut that is expected for this month, right? If you remember previous FOMC meeting, Powell threw cold water on the idea of any kind of rate cut for December, but that has changed significantly, especially with certain Fed members coming out and saying that no, they see a rate cut, and there's mixed comments about it, and also the data that's been coming out showing weakness in the labor market, weak inflation as well. So all pointing towards, the chance of a 25 basis point rate cut in December is likely. So today we got some more layoff announcements, more news. We got the Challenger jobs data coming that came out. Layoffs, basically the announcements top 1.1 million this year, the most since 2020 pandemic. So we're seeing bad numbers, yet the markets continue to march up higher. And this goes to the whole idea of what I've been saying on this channel about the whole K-shaped economy, where certain segments, sectors are doing poorly, going down, versus other ones are doing better. And definitely consumers are feeling the pinch. Now, what's very interesting also, we heard news about Cyber Monday and also Black Friday sales being totally fine. Being showing resilience and strength of consumers. This could be just due to the holiday times. Could be also that consumers feel frustrated and they're gonna spend anyways. You may feel it in your area, maybe not. But that's what we've seen in the news flow in terms of the Black Friday sales looking came out kind of better than expected. So a lot of mixed data, mixed information, but definitely there is weakness, and you do see the layoffs increasing, especially with this Challenger jobs data that came out. So basically, the number totaled 71,000 in November. So a step down from the massive cuts announced in October, but still enough to bring the total up to 1.17 million. So when I look at the number here, this number is around 71,000. The last number came out 153,000 in job cuts. So a little bit less than the previous month, but still something that's adding to the 1 million mark for this year, and much higher than the COVID levels, right? When you add it all up together. So that's pretty alarming. So also, with this number, what's the cause of this? So they basically says corporate restructuring, artificial intelligence, and tariffs basically were some of the reasons. Like I mentioned before, the AI, the whole idea of like some of these firms using AI more of a reason to cut jobs. You have also corporate restructuring, profit issues, growth issues down the road, in certain sectors as well. Another issue there. In November, Verizon announced that it would slash more than 13,000 jobs, help to drive also the total here. Tech companies driven by innovation AI listed 12,377 reductions, pushing the sector's 2025 total up 17% from a year ago. So you're having tech companies also ads saying that, hey, AI is doing the job, so we don't need these jobs. So let's add to the total, bringing it to that 1.1 million for the year. AI itself has been cited for 54,694 layoffs this year. Tariffs was also another driver, about 2,000 cuts, small in comparison to the whole AI thing and what Verizon's doing for restructuring. So a small amount, but adding 2,000 cuts in November and nearly 8,000 for the year. So that doesn't help. And basically, the layoffs plans fell last month, certainly a positive sign. That said, jobs in November have risen above 70,000 only twice since 2008, in 2022 and 2008, said Andy. Um, so when we look at this, along with the Challenger, we had the ADP number that came out yesterday as well. This is the private number. So this number looks ugly as well. We have negative 32,000. So basically 32,000 jobs that are being cut, led by steep small businesses. So it mentions here that larger businesses and tailing companies with 50 or more employees actually reported a net gain. So the bigger companies are doing fine, but these smaller ones, the establishments with 50, saw a decline of 120,000. Now here's the thing, right? Small, medium-sized businesses make up for majority of the jobs, believe it or not, in America. They're the backbone when it comes to the labor market for the U.S. The big companies out there, the larger companies, yes, they're huge, but they make out a small percentage of this labor market. So the fact that the small, medium-sized companies are being affected, and the large ones are not so much in this ADP report, is still a very telling sign and a negative sign that that's not good, because we know the small, medium-sized companies, they are the ones that make up for the most of the labor market in America. And if that's the case, then that questions how will Christmas spending be like, and how will 2026 be like, especially if things get worse off. The jobs data here also paints a picture that the Federal Reserve, possible that we could see the rate cut, especially after this negative data. So that adds more fuel to the fire there. So again, the probabilities have changed significantly, like I mentioned, going from no rate cut to now a high chance of a rate cut for December. When we look at the ADP number, if I just pull it up here, like I said, negative number. So the forecast was 5,000. It came out minus 32,000. The previous number was about 47,000. And so 47,000. This is the updated number. And if you look at the previous reports in October, it was negative there as well. July was negative. So we're starting to see a trend, right? If you see since 2021, starting to see a trend in ADP where the numbers are now getting lower, and we're now seeing more negative numbers. This is going to be interesting heading into next year in 2026, especially if we start to see deeper negative numbers, right? Last time in 2021 we saw 78,000. COVID time was definitely bad, right? You can see a massive dip there. Let me see if it can take me to 2009. So 700,000 negative jobs there during the real estate crash, and negative 300,000 for the dot-com bubble bursting. So we're at 32,000. We see the trend here slipping lower and lower. And so nothing big in terms of a big negative number, but the trend looks like we're going there, which is no bueno, not looking good. Now, when you look at the markets, right, the S&P 500, we're seeing some choppy action today. When we look at on the daily, we did see some sell-off, but we've kind of retraced most of the sell-off here, and we're just kind of sitting idle here. So will we see a Santa Claus rally where the markets grind up higher to the 7,000 level and break it further, or is this it? Is this the top? Well, right now with the price action, it's looking quite strong for equities where the dip buyers continue to come in. So regardless of, the numbers, whether the job market's doing bad or good, the equity markets are shaking it off and looking at it as a good thing. You can see it here on these rallies after the numbers come out. They're viewing it as a good thing because of the whole rate cut situation, right? Same thing here with NASDAQ, pulling back up, most of its sell off. Russell 2000 is doing pretty good. We're seeing it very close to all-time highs and right now trading positive versus the other markets. Dow Jones, same thing, but a little bit negative here today. So, what do I make of all of this? Well, there's no doubt that the job market is weakening. There's no doubt that the economy is weakening. When you look at markets, it doesn't have to be that if the job market's weakening that you're going to see a crash in the markets. Crashes don't happen that easily, especially with the equity markets and especially with the price action that we're seeing. Does it feel toppy? Definitely, you can argue it feels toppy. You can argue really both sides. But the fact of the matter is that we still continue to see buying the dip situations here. And as long as people continue to be fearful in equities, my take is that we continue to grind up higher if that's the case. If people, FOMO in, or if there's some sort of catalyst for next year, then you could argue that we could see some selling pressure. But until then, right now, there's with the current price action, especially for now and this month, it's looking positive. Yes, you're going to get more volatility, uncertainty with news and data, and especially with more data that we're going to get. But the price action does favor more to the upside and more for the bulls. So until then, until something changes in terms of the catalyst, in terms of the news flow, in terms of news failure, in terms of positioning, in terms of FOMO and whatnot, this market continues to grind up higher regardless of the weak data that you're getting. So anyways, let me know what you guys think of all of this. Are you seeing some signs in your city, in your markets? What do you think about it? All this that's happening. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers. Bye.